Hello traders, in today's video we are going to be going over a clip that I found beyond cool, which is a experiment in market bubbles. Watch this.
In this experiment, Smith wants to see what happens when students compete to earn money on a simulated trading floor.
Participating in a trading experiment?
It's not a classroom setting. It's a setting in which your job is to make as much money as you possibly can.
Will be paid based on the dividends that you have earned, plus any
If they
profits
play the
you
game
lost.
well, they could earn hundreds of dollars.
This is real money, serious money.
Each of them has been given an imaginary financial asset to
You will be
trade.
trading an asset.
And right from the start, they're told to be careful because the asset will decline in value over time. By the end of the game, it will be worth nothing.
Okay, the experiment has begun.
On the screen, they see the prices the other traders are offering to sell or buy at.
So you can see here we have what was set up as a traditional order book where you can buy the best offer, meaning the lowest limit sell, or you could sell the highest limit buy, highest bid. You can also elect to submit your own bid or submit your own offer. So all offers are above the 275 that you can see right there, and all bids are right below the 230. So think about, what would you do in this experiment? How would you play this differently than how the students did?
And they also see the value of the asset as it relentlessly declines. Shown here is a dashed black line heading downwards. As prices rise, they reach the actual value of the asset. And something strange happens. Everyone begins to take risks.
So you notice the price has been racing up.
In the hope of making profits, they now trade high above the real value.
So now what's happening here is in purple you can see the limit buys and the limit sells, and blue are where trades were executed. Now look at the black. The black shows what the actual value of the asset is, and you can see that traders are buying higher and higher and higher while the actual value of the asset is actually falling. So what's your best guess at what's going to happen next?
There's quite a frenzy, way above fundamental value.
In the flurry of buying, the students are now ignoring the fact that the asset will soon be worthless.
We're in period 10, and at the end of period 15, these assets are worth nothing.
As the end approaches, the price remains way above the real value. The graph has taken on a classic bubble shape. And when the players try to get out, no one wants to buy. Instead of earning hundreds of dollars,
Now you can see that the actual value of the asset, which is again that step ladder in black, is very low and just continuing to fall. But an issue that happened in this bubble experiment is for every seller you need a buyer. And a lot of people had bought because at the initial phase of this little experiment, remember that the traded value was way below what the actual value of the asset was. So everyone rushed to buy. But what they forgot to think about is the long term, that asset's value was going to continue to fall over time. They were just looking at it in the short term. So you can see here that there are so many people who want to sell, but they can't because no one wants to buy at prices that are that high of where that flat line is. So what ended up happening is the next sale was far below what it was before.
the students watch the graph collapse, leaving them with next to nothing. This experiment suggests bubbles may be part of the fabric of financial markets.
We've done hundreds of them now, and with all kinds of different subjects. I went to Chicago and I recruited some over-the-counter securities traders, put them in an experiment. They gave us a magnificent bubble.
Now look here. In green, you have the fair value price of Bitcoin, and in orange, we have the actual price, the actual traded price of Bitcoin. Now, if you want the methodology for how do you calculate fair value, the factors are here, and if you want to know the calculation for that, you can find that here. So let's go look at what ended up happening in the 3 stages of a classroom versus Bitcoin, of a bubble. First stage, we get that irrational exuberance of so many traders who just want to buy. Now we can see here that the price was around its fair value, somewhat, and then it just takes off like crazy. And that's what happened in the classroom as well. Then we get the peak. In the classroom experiment, they had more of just a consolidation flat line. But here we get a peak, and then that leads to the panic. This led to the panic because there's an oversaturation with buyers. There are just too many buyers, and there aren't really anyone to sell to, because in order to sell, you need to sell to a buyer. And in the classroom, no one was willing to buy at those elevated prices, so that's why the price tanked. Same thing with Bitcoin. There came to a point where no one was willing to buy at such elevated prices that the price had nowhere to go but to fall. And even when the price tried to climb higher, really it failed, because there were just so many buyers who wanted to sell that it wasn't even able to make it that high. And then the price crashes and eventually actually even sells below what fair value is calculated to. So this is really a lesson in the 3 stages of what can happen with a bubble. Bitcoin is not, I'm not saying Bitcoin is a bubble, but what I am confidently saying is that it took the shape of a bubble before. Now, right now, what's going to happen, I do not know what will happen the next few years to the price of Bitcoin. But I do know that this, for sure, looked a lot like a bubble in 2017, 2018. Now, that experiment and really the fair value versus the price of Bitcoin here, you can see this on even very small time frames. If you look at an altcoin pump and dump, what you're going to see is that there's that pump phase of an altcoin where everyone wants to buy into that altcoin, and then you get to such an elevated price and just so many buyers who want to sell out and take profit that you go like this, and then price either does this or that. Sometimes price does this, like in the classroom, and then the panic sets in, and then it just tanks. If you know this, you're ahead of the curve already. However, do be very, very careful when you're trying to identify bubbles, because you don't want to be stampeded, run over by the herd by trying to counter the herd because you say, hey, I'm going to short here because we're way above fair value. You'd be destroyed. You'd be killed. But you also don't want to join the herd, because if you do, you're right down, here. What you need to do is have the ability to recognize when a shape like this is occurring. Think about the 3 stages of how these bubbles form, and then maybe you're actually the one who's shorting up here and shorting when everyone else is panicking, and profit from their panic. With that, that's going to do it for this video. And let me know what you think of not only Bitcoin, but also of the students from that little simulation at the university. Happy trading.